You're listening to Market Champions, a podcast on navigating the financial markets. Here's your host, Srivatsan Prakash.
Hey guys, welcome back to another episode of Market Champions. I just wanted to remind you to like, subscribe, and leave a comment. Really helps the page grow, really helps the podcast grow. Thank you so much for your support. And now on to the interview. Hey guys, welcome back to another episode of Market Champions. Today, I'm really happy to have Alfonso Peccatiello. He is the head of fixed income trading at ING Germany, which is a very big bank in Europe. He's also the publisher of the Substack newsletter called the Macro Compass. So it's themacrocompass.substack.com, and you can go find him on Twitter as well at MacroAlf. So MacroAlf, and he's been featured on like really big platforms like Real Vision and so on. So thank you so much for being on the podcast, Alf. It's awesome to have you.
All right, so my pleasure. You've had awesome guests, so my heritage here is very hard to keep up, but I'll try my best.
Thank you. that's very kind. So I wanted to start off by asking, what is your journey to, the trading world, the investing world, and how did you find your way here? What is your background? And could you just give us a brief summary of how you got to where you are?
Yeah, so I basically work on Boring Street, which is the European brother of Wall Street, as I like to call it. No, just kidding. I work for a European bank, and I manage a large book for them. But a small disclaimer, I'm here speaking on my behalf and not on behalf of my employer. So anything I will say here, it's my own opinion only. How did I get there? When I was a kid, I was very curious, and that helped me a lot. So my mother used to manage, still is actually a treasurer of a small bank in Italy. I'm Italian. I guess my accent gave that up already. Can't do much about it. But so when she came in for lunch breaks and I was in high school, she had this computer on the table because she had to follow charts, especially Italian government bond future and how it moved. And, I was eating pasta. That was very good, but I didn't understand anything at all of what that chart was meaning. So I was asking her questions, just a curious teenager. And she was trying to explain to me how that works and what she's doing. And at some point, I became more interested, started doing my own research, and then went to university to study macroeconomics. Then I did quantitative finance in Germany, actually, and then ended up working for ING. Moved to the Netherlands, which I liked, and career then went relatively quick. And I was, how can I say, lucky enough to have very good mentors, which are extremely important for a young guy who starts in this business. So curiosity and good mentorship is gonna, make a lot for you.
Got it. I know you're sort of known for your view on disinflation. So could you sort of give the audience, an idea of why you are in the disinflationary camp? You're not entirely like outright deflationary, but you're also not in the inflationary camp. You believe that we're going to see some amount of disinflation. So could you just give your thoughts on that?
Yeah, so you basically mentioned my Substack before, which is called the Macro Compass, and it's called the Macro Compass just after the main tool I use for macroeconomic analysis, which is a compass with 4 quadrants. And on the x-axis and the y-axis, the two driver of the positioning within quadrant 1 to quadrant 4 are the credit impulse and the monetary policy stance relative to neutral monetary policy stance. And the credit impulse here is the key metric. So basically, credit impulse effectively measures the pace of change of credit flow to the real economy. So for geeks out there, will be the second derivative of credit stock, but to make it simple, will be the acceleration in credit out there. And that's important. So we're not talking about delta, we're talking about the pace of change. Now, why is that so important? Because people always tend to confuse liquidity with credit. So liquidity would be central bank swapping an existing bond for bank reserves via QE. It would literally boost reserves of the banking system, would provide them with more liquid assets, liquid ownership of zero duration assets, which are bank reserves. Credit is a different thing. Credit is the effectively expansion of real inflationary form of money towards the real economy. And there are a few entities that can do that. Those are the commercial banks by lending money out, and the governments by spending more than what they plan to tax for via deficits. And those are the two main drivers of the credit impulse. So in 2020, for example, this credit impulse went absolutely through the roof as a combination of unprecedented net deficits driven by the US, but by all governments all over the world. And at the same time, government-sponsored bank lending. So you had programs where the government was effectively covering the credit risk from the banking sector to lend money out. And of course, the banking sector lent money out because they had effectively no counterparty risk, or they had the government as their counterparty in terms of credit risk. So the combination of the two brought this sugar rush, credit-induced reflation impulses.
Yep.
That is a very temporary nature, and we see that very often. So we have seen that in 2018 when Trump put on a pretty large fiscal expansive plan when the output gap was estimated to be negative in the United States. And as a result, in late 2018, you had core inflation, which was printing around 2%. You had real wages that were going up. You had nominal wages about 3% year on year going up. So during those periods, and normally last a couple of quarters, where there has been a credit expansion towards the real economy, either from the banking sector or from the governments via net deficits, you have all these guys which are hyped up about the regime change. It's always a regime change. I've been waiting for this regime change for 20 years. It's always there. Every time there is this reflationary, short-term, sugar rush, credit impulse-driven few quarters of reflationary impulse, people go with regime change. The reality is that for every of this credit impulse, there is always a credit cliff.
Yep.
Because the second derivative of growth of this credit impulse effectively will mechanically go down when next year you're not able to keep up the pace of credit creation you had last year. And that's also what we're seeing now. So what we're seeing now is the immense amount of credit impulse last year led to this reflationary impulse, but it's already winding down. Between May and today, you had industrial commodities dropping, you had the Nasdaq outperforming Russell, you had emerging markets underperforming developed markets, you had bond market, which is trying to scream at you that this is the nth false breakout, false regime change. This is just another big temporary credit-driven reflationary impulse that is going to morph back into the structural factors and the structural drivers. And those are the same. They've been even worsened probably by the pandemic, because the long-term structural growth of the economy is driven by the same factors. Those are the labor quantity, so how many people actually work and contribute actively to the labor force, and how productive are they, and how productive is the capital they have at hand. And labor supply, even in America, is negative. I'd like to stress that out. Next year, America is going to have a smaller labor force. The year after is going to have a smaller labor force than the year before. Can you imagine how difficult it is to grow structurally when your labor force is shrinking? Even in America, in Europe, it's worse. In Japan, it's worse. Productivity is stagnant and capital is misallocated all over the place. So you have very, very low structural growth. Disinflationary forces are there. Tech is scalable. And by being scalable, it means we are not in an industrial age. Those are not the 70s. This is not a human intensive age. This is, a scalable tech-driven age. And those forces are there to stay.
Got it. And, today we also saw some CPI numbers that were, I think, if I remember correctly, it was around 5%. So do you have any thoughts on it? And do you have any thoughts on sort of, number one, the supply shortages that we're seeing, and number two, do you have any thoughts on when that's going to ease and when we're going to see, CPI come back down? So in the sense that, when will CPI numbers start to matter again? So at the moment, because of base effects and because of the supply chain blockages, we're seeing a lot of these numbers. So these numbers are like super noisy. They don't have that much value as a trading signal. So now, around when does the noise to signal ratio go down again with these CPI numbers?
Very valid question to distinguish the noise to the real underlying signal. Yeah. I don't want the audience to get me wrong. I am on Twitter effectively actively for 5 to 6 weeks, but before that I was very active on LinkedIn. So if you go and check me out there, 8 months ago or 9 months ago, I was out there telling people that I expected core PCE in America to print about 3%. And the reason why I thought that is because net disposable income correlates very well with core PCE prints with the 6 to 12 months lag. And it makes sense because you have American families having the larger net disposable income, and you will assume that some of this money will be spent through the real economy, pushing up effectively some items, at least of the core PCE basket, right? And that's exactly what we are seeing coupled with supply bottlenecks. And the reason why net disposable income was higher during the pandemic, well, that's pretty simple. It's because the government effectively offset all the losses and more. So net disposable income went up, and with the 6 to 12 months lag, you have core PCE printing higher, around 3%, even much larger today, because supply bottlenecks are also playing their role in all of this. So you still have to distinguish, though, the cyclical pickups from the structural trends. And we are right now probably at the top of the cyclical pickup in core PCE with the 4.5% year-on-year print. That's pretty aggressive by any standards.
Yep.
And true, there are a lot of volatile items in there, like used cars are up 11% year-on-year. Okay, sure. That makes that if you even if you exclude all the volatile items and you look at the stickier items, so sort of the trimmed core inflation metric, even that one is relatively big. And it does make sense to me. What it doesn't make sense to me is expecting that this will continue and morph into an inflationary spiral. And the reason why I can't see that happening for a couple of reasons. The first is that, do you expect these supply bottlenecks to never be solved? Like literally, do you expect that next year producers or later this year, with the pandemic restrictions actually being eased, producers are not going to be there to catch the opportunity and have higher margins and therefore produce more of, for example, commodities that they can lock in at these prices when they sell? Do you expect supply to never catch up? But more importantly, do you expect aggregate demand to be as strong as it is today? And if you expect that, where would that push come from? I can tell you where the push to today's aggregate demand came from, and it's the massive credit impulse that we had over the last 12 months. In percentage of GDP, that's almost unprecedented.
Yep.
So obviously people have more inflationary form of money, literal credit at their end that they can spend if they're willing to, so they can boost aggregate demand. But these checks are not there anymore. When is the last check that America sent around? It's not yesterday. It's actually a few months ago. Unemployment benefits are rolling over. Banks are not lending. That's pretty simple. I mean, banks have no incentive to lend here. The credit demand, on the other hand, is pretty low. And the reason why it's low is that the private sector is over leveraged. People look at the public sector always. They forget to look at the other side of the coin. US private debt to GDP is 165%.
Wow.
The private sector is already very, very leveraged and has very little appetite for taking additional credit on board. One signal of that is that Americans used about 50% of the fiscal checks, the fiscal stimulus checks, to basically pay off existing debt. So if the government is trying to create credit from one side, then the private sector took half of that credit and destroyed existing money by paying back their loans. So I can't see where the permanent boost in aggregate demand, which is needed to push up inflation higher and higher in a year-on-year spiral, which it's self-fulfilling, would come from. I just can't see that.
Do you think that we're gonna? I know you don't like the term regime shift, but do you think that if we see if you see say over 5% fiscal deficits that are permanent over the next 5, 6, maybe 10 years, do you think that would lead to an inflationary regime shift? Because as we were talking about aggregate demand, one of the components is government spending, and we are seeing deficits that are really, really large, and it actually hasn't been this large since World War II. So do you think that fiscal deficits and the government spending pose a major risk to your disinflationary thesis?
Well, it's for sure one thing to keep on the radar as a risk to the secular trends thesis that I'm basically putting forward here. But I have two counter arguments to that. The first one is electoral cycles. So people tend to think that the government is there forever, but in America, effectively, you have, with midterm elections, a short electoral cycle every 2 years. So you'll have elections every 4 years and the midterms every 2 years. So you're seeing that already with the infrastructure plan, right? Where It's not as easy as it was at the beginning of the Biden's administration to push through all these expensive monetary fiscal policy packages, right? In Europe, well, that's even worse because you'll have 19 euro adopting governments that are going to have elections effectively, every 6 months if you overlay them. And, it's not that they can push a fiscal agenda every year in a very easy way. It's not that simple. And even if there was the political appetite from any government out there to keep on expanding leverage and, pumping credit through the real economy via net deficits, then I still have a question. Japan has been doing that for the last 6 to 7 years. Mm-hmm. Japan deficit to GDP for the last 6 years is 6% on average. 6% deficit, so it's even higher than your suggested 5% hypothesis. It's even higher. The Bank of Japan has been buying in percentage even more than that. So it's full debt monetization, if you want to call it like that, from the central bank, which I don't like as a term, but okay, let's just make it simple. So the central bank is buying more bonds than the government is actually issuing in net deficit. So that's the perfect setup for inflationistas, right?
Yep.
6 years and counting of that going on. Where is the inflation in Japan? And people would still tell me that, yes, of course, it's because Japan is an aging society and it has current account surplus and so on and so forth. And I know all of that. But here you're talking about a potential huge regime shift where the government prints every year 6% of deficit to GDP and the central bank buys even more than that. There is not even the slightest hint of inflation. And do you know why is that? It's mostly because the private sector is doing the opposite job of the public sector. So the public sector is trying to create credit, and the private sector in Japan is telling you, sorry, I don't want that. If you keep on pumping credit, I'll either save it or I'll use to pay back my existing leverage. Yep. And why do I do that as a private sector? Is because I don't see any outlet for productive investment. I do realize my real wages are not going up. And you cannot push up real wages by artificially manipulating the amount of credit into the economy. You need productivity. You need a healthy structural trend growth, which is not there and you cannot artificially create.
Got it. And your pinned tweet on Twitter is the ECB is likely to buy about 100% of all the net borrowing needs from European governments, and then the private sector needs to absorb net zero, and holy crap. So is this not similar to what the BOJ is doing? And if not, what is different, and what are the consequences of this? Because you said that the BOJ it's buying up and quote unquote monetizing all the debt that the government of Japan is issuing for over 6% deficit spending. So is there something the ECB is doing that's different? And if not, what are the consequences of what the ECB is doing right now?
It's a good question because the European Central Bank is exactly applying the same strategy as the Bank of Japan, and any other developed market central bank will be forced to do the same. Mm-hmm. So how the system works is that we as humans do not accept very low growth. We like to shine, and we like to shine now. We have no patience. Yep. We are a special species with no patience whatsoever. So we like everything now and everything today, and everything must be perfect. So if somebody would tell you that R star, so effectively the natural rate, real interest rate at which the Eurozone economy doesn't either overheat or cool down too much, is estimated to be negative 1.5%, again, negative 1.5%, you would be very scared. Somebody would be telling you that in order for the economy not to fall into recession and to maintain a decent level of employment out there, you will need permanently negative real interest rate. And that's because, labor supply growth is terrible, productivity is horrible, capital is misallocated, and so on and so forth. And, the only way to kick the can down the road is to borrow more public debt and private debt, and effectively to pump credit through the economy and overlay some cyclical growth on top of this horrible, even negatively estimated to be structural growth. But you overlay some cyclical growth on it, and the current generation And politicians might still say, yeah, but nominal GDP in Eurozone was plus 1% on average, right? I mean, real was close to zero. There was some inflation on top, and so that's acceptable. I mean, it's not great, but it's okay. What it's not acceptable is to be in permanent, recession almost. That's not acceptable in real terms, I think. So what we do is we borrow more and more, and in order to make this somehow sustainable, we have to keep real interest rates very negative.
Yep.
The trick is to keep real interest rates on first of all, on risk-free assets like government bonds below the trend real growth. So if you manage that, then effectively you will be able to stay afloat and kick the can down the road by inflating your debt away. So as long as your real interest rate payments, your real coupons to service your debt are lower than the cash flows you get from your real growth, then that's not that bad. I mean, you can keep on doing that. The private sector will suffer a bit more because they'll have to pay a credit spread on top of this risk-free real interest rate. So people say real yields are negative, and I want to puke. They are not, because nominal real yields are 4%, and you're subtracting today's inflation out of it, which is a bit of a nonsense. But if you're a corporate, if you're a private sector, you're a currency user, you're not a currency issuer. So when you're a currency user and you're the private sector, you need real cash flows to service your debt. You cannot just say, okay, I'm going to go into deficits. That's not how a balance sheet of a private sector corporation or household works. You need real cash flows to service your debt. So if you push risk-free real interest rate to extremely negative territory, which is the aim of the Bank of Japan, the ECB, and now the Federal Reserve, even if you overlay a credit spread on top of it to service a mortgage or a high-yield corporate payment, you will end up at extremely low real interest rate coupons for the private sector too. So even an over-leveraged private sector can sort of survive in this environment. But what this does, it incentivizes capital misallocation. Fixed income buyers will have to buy high yield at the real coupon of about 1%, which is really doesn't reward you for your credit risk. And this in turn will keep alive zombie companies. And you can see it's a vicious circle. It's a vicious circle. You don't get out of it.
Yep. And what do policymakers actually have to do in order to cause structural inflation? What can they do to make a shift from structural disinflation or structural deflation into sort of secular, or a cycle of secular inflation?
Nothing that they like, and that's the point. I mean, there are two ways out of it, I think, and none of those are very easy to swallow. And both of these will cause linear and convex market reactions or social unrest at some point. There is one way, which is the one we're applying today, which is to keep real interest rates negative, possibly below real GDP growth for as long as possible, such that effectively the purchasing power of the private sector gets reduced year by year. And on the other end, the public government, but also the private sector borrowers actually get some respite because they inflate away the debt burdens in real terms. So if you're in Europe today, it's a typical example. You have money on your bank account, you pay negative 0.5% for the luxury to own your savings. So most European banks are effectively forced to apply already negative nominal interest rates on your bank account above a certain threshold, which is very low. It's 50,000 euros or so, something like that. So the average person will get his savings charged in nominal terms. Then inflation, of course, will charge your savings as always. So in real terms, your charge will become negative 1.5% or so. And on top of that, you will have a wealth tax of sorts that will also bring down your real purchasing power even more. So by keeping your savings there, you're effectively charged about 3% a year. And this charge benefits, on the other end, the borrowers, right? The government, first and foremost, but sometimes also the private sector, which can issue at negative real rates bonds out there to refinance themselves. So that's one way. If you keep on doing that for 20 or 30 years, in the 40s, a similar strategy was applied where real interest rates were kept deeply negative for almost a decade. And that destroyed purchasing power of fixed income buyers and savers to the benefit of government and debtors. But if you do that, you're almost guaranteed to have social unrest.
Yep.
At some point, people realize they are charged 3% purchasing power a year, and the real wage is not going up 3% a year. Real inflation adjusted is not going up 3% a year, the median wage. They won't accept that, and they will start voting for extreme far right or extreme far left. So the discussion will become more polarized, and at the worst, you'll have social unrest straight away. And social unrest is never an easy thing to handle. So in that case, you will have non-linear reaction from the society, right? The other way is to have non-linear reactions from the market by allowing upfront large wealth destruction right now. So you take the excesses of the last 40 years and you try to cancel this straight away. So you're punishing the current generation, maybe the next one as well, in a gargantuan fashion for the last 40 years borrowing. So home prices will drop 50 to 60%. The S&P has to go down 60% or so. It's a complete wipeout of pensions,
Yep.
of current wealth. So tell me, which elected official is going to go for it? I mean, the pandemic came and it was the perfect exogenous variable to blame, right? I mean, it's a virus, and what are we going to do with it? Okay, let's allow for a deleveraging, and sorry guys, you will be wiped out 50% and bad luck, right? This could have been one way, but it's pretty clear from official institutions, governments and central banks that they won't allow that. The problem with this is that you will kick the can down the road towards an unsustainable market structure in which it seems it's a linear behavior like it is today, right? I mean, euro dollar doesn't move, it's impressive, or the implied vol and realized vol of S&P extremely low, right? Everybody in the same trade, everybody short gamma, everybody short convexity, until the system breaks down, and then you're subject to unpredictable convex payoffs rather than linear market reactions, and for sure some sort of wealth destruction.
Got it. Yeah. Yeah. I mean, I agree with you, because I don't think any elected official is actually going to implement such policies, because that just means that they're going to get kicked out of office, and no elected official wants that. And one other thing that I wanted to ask you is, a lot of people mistakenly actually compare what the Federal Reserve and the ECB and the BOJ are doing right now to what happened in Zimbabwe earlier in the 2010s, and what happened in Weimar Germany in the 1920s. So what actually do they get wrong? What is the big mistake they're making when they're comparing? Because one of them one of them saw an extreme amount of hyperinflation. The other one is the other one saw the other one, meaning the ECB, BOJ, the Fed, we're not seeing anything at all, or we're seeing like really, really low rates of inflation, 1 to 2%. So what is the big mistake they're getting? What is the big mistake they're making here? And what are they getting wrong?
What they're getting wrong is that bank reserves are not outside inflationary form of money. They cannot be lent out. They are simply a settlement instrument for interbank payments. And that is it, full stop. Reserves cannot be lent out. They are not lent out. That is not their function. There is no money multiplier. If a bank has a quadrillion reserves, it will not mean it lends more money to the real economy. There is zero correlation between the amount of reserves and how much money reaches the real economy, which is what actually creates inflation. When the aggregate demand and the amount of available credit and inflationary form of money for the real economy is much higher than the standard, then the same money will chase the same basket of goods, which is unchanged, and therefore price of this basket of goods will go up, and possibly you will have an inflationary spiral if this mechanism is self-fulfilling and self-feeding, right? So let's go back. Quantitative easing creates bank reserves. Yep. What it means is that the central bank on the liability side creates reserves effectively out of the thin air. That's one of the things they can do. And they take these reserves and they buy bonds from private sector. So it can be whoever. Actually, they buy bonds from dealers. That's how it works. But to simplify, let's assume the bonds were owned by a treasury or a pension fund or whoever, right? And they effectively forcefully change the composition of the asset side of the private sector. So they say, okay, you were holding 100 bonds and zero, I'm going to call it not cash, for the purpose of it, but zero duration assets. So you were holding some duration intensive assets, bonds, and some zero duration intensive assets. You want to call it cash, let's call it cash, but I think creates a lot of confusion. And then they take these reserves and they effectively force you to change your composition. Yep. Because you have to sell this bond somehow to the central bank. They will bid up the price until you will sell the bonds to them. Actually, the dealers will sell the bonds to them, but then the dealers will look to buy the bonds from you to sell them to the central bank. So you are a pension fund, and all of a sudden you have less bonds than before. And you end up with actually more deposits overnight at a bank, at a commercial bank. Because a pension fund doesn't have access to overnight central bank, it has to go through commercial banking system first. But in the end, somehow, always in the system must own more bank reserves than before. Yep. Some commercial bank will own more bank reserves. They can trade these bank reserves within each other. They can lend bank reserves towards each other. But those bank reserves that have been created and sits on the liability side of the central bank and on the asset side of the banking system can never be lent out. So the idea of quantitative easing, which, it's in the name already, it says quantitative easing. So the idea is that at some point, there is a quantity of reserves that will be inflationary. Okay, so the whole idea is just bollocks, sorry to say. But banks lend based on different incentives. They lend if their return on equity on their loan books is good. It rewards them for the credit risk they're taking towards, borrowers out there. So the return on equity is effectively two things: is the loan yield itself, which is today extremely low, and the capital that you have to attach to this loan is effectively a provision for potential credit losses. So regulation is very tight, and capital you have to attach to these loans today is relatively large. Against it, you have a terrible loan yield. So, and on top of that, credit demand from an over-leveraged private sector is just not there. So banks are not lending. Without sustained bank lending, there is no sustained aggregate demand pickup and therefore no inflation. So the whole quantitative easing story is going to be inflationary at some point. It's just bollocks.
Yep. And there's like a lot of misconceptions that come from this. And for example, if you thought that quantitative easing was money printer goes burr, then you would start to think that quantitative easing is actually inflationary. And you make the point that it is not, and it actually doesn't do anything because it is not because it's not the Fed or the ECB or the BOJ printing money. It's just simply reserves that are used to settle interbank transactions. And so, one thing that I wanted to move on to is the US dollar. So stemming from this view that number one, we're not seeing money, the money printer, printing dollars. What we're just seeing is just addition of bank reserves. So what are your views on the US dollar, especially as someone who is rather bullish, who is rather bullish on bonds? And, we've also had a lot of people who were short the US dollar earlier this year. They were kicked out of their shorts, they were squeezed out of their shorts. And how are you thinking about the dollar? Because there's almost just there's almost just two camps here. One of them is arguing that the dollar is about to lose its reserve currency status. Look at the Fed, it's printing all this money, and we've got Bitcoin and this and that. And then the other side is just extremely bullish on the dollar, and that's people like Brent Johnson and the milkshake theory and so on. So how are you thinking about the US dollar, both from just a trade idea and a trade perspective, and also long-term, your long-term view? Do you think that it's going to lose its reserve status, say, in the next 5 to 10 years, or do you think it is still the strong hegemon at the center of our financial system?
Yeah, so I'm gonna say that first of all, the first comment I have is that if you want the currency to lose your reserve status, then you need another currency to gain the reserve status.
Yep.
And people like to make blunt statements. All right, I like that. You'll have to be realistic. So if you still are in an elastic money supply system, which is a fiat-based monetary system with no hard assets backing your fiat money supply effectively, then you need to elect one other fiat currency to be replacing the dollar. Mm-hmm. And I challenge everybody to come to me today and point to me to another reserve currency that might have even in 10 years all the features which are required to be the global reserve currency. And that's, trust me, it's very, very hard to do. I also tried the same exercise, but it's very difficult. So of course, if you move the rules of the game, and then you say, okay, it's not going to be an elastic money supply system anymore. It's going to be maybe a coexistence of this money supply system with backed somehow by a hard asset. And you can be in the digital camp, or you can be in the gold camp, or you can be in whatever scarce hard asset camp. We tried that already with gold standards, and it didn't really end well. So, I just point out to the audience here that if you want the dollar to lose the reserve currency, then find me another fiat currency that can replace it, or we should talk, hard asset backing the money supply, and that's a completely different ball game. Coming back to the dollar, let's first talk about the dollar against other fiat currencies, because when people ask me about the dollar or other currencies, I always ask them against what. It's one currency, so you're trading it, but against what? So if I look at the DXY, that's the dollar against a basket of other currencies, right? And what drives that over the long term is real interest rate differentials, is one of the drivers. So here we are basically doing a race to the bottom. Who is the jurisdiction that is able to produce the lowest possible real interest rates? Everybody's over leveraged. Everybody has a sum of public debt plus private debt to GDP, which is north of 300%. Everybody needs some sort of financial repression, and negative real interest rates is the easiest politically acceptable way until there is social unrest. But until there is nothing like that, people will just apply that negative real interest rates. Now, during the reflationary period, you have the US able to produce the lowest real yields across the developed market world, right? Because what they do is they're able to push nominal interest rates maybe at 0% or so. So the Fed funds rate at 0%. But inflation expectation in America tend to be higher than the developed market counterparts, because America is perceived to be more productive, is perceived to be a higher potential growth economy compared to Europe or Japan or whoever. So they're able to push real interest rates lower by a combination of 0% nominal interest rate and higher inflation expectation compared to their peers like Europe. So you have dollar with very low real interest rates, lower than euro real interest rates, for example. And then guess what? The dollar loses its value against the euro and against a bunch of other developed market currencies. So DXY goes down. And that's what happens during the reflationary trades. There is abundant supply of dollars, and dollar real yields are lower than their peers, right? And all of a sudden you move to today. You move to today when, let's say, the supply of dollars, or the second derivative of supply of dollars, is slowing down pretty aggressively because the credit impulse has peaked. So we haven't had a fresh injection of dollars towards the real economy straight away, or at least it's less than it was before.
Yep.
Let me put it like this. And then you have the Federal Reserve, which has an incentive to try and get out from the zero lower bound and excessive monetary policy accommodation when they have a small window to do so, such that in the next crisis, they're still able to somehow react by becoming accommodative again. But to become accommodative again, when you are at zero lower bound, you need to become, somehow tighter first. And when America does that, and the credit impulse is lowering at the same time, that's one of the perfect cocktails for dollar to appreciate, plus an extremely crowded position at the beginning of the year where everybody and their mothers wanted to be short dollar. And it makes sense, it reprices a bit, but we're talking ranges. We're talking DXY trading in a very boring range against a bunch of other developed market currencies. What I like to look at is the dollar against hard assets. And that's an incredibly clear trend. I mean, the real interest rates have been going down and down. I put down a chart on my Substack or on Twitter, I don't remember exactly, where I show total debt to GDP in America inverted and put on a chart against real interest rates.
Yep.
It correlates fantastically. So if debt is increasing, which is inverted on the chart, it means it's dropping on the chart. The real interest rates are dropping too. So as we become more and more leveraged, you have real interest rates going down, and therefore savers, or people that are forced to own dollar, because the dollar is the global reserve currency of the world, and a lot of trades happen in dollar, and a lot of cash flows are priced in dollars, and commodities are priced in dollars, they will find a way to preserve their purchasing power. And so they're looking for real purchasing power protection, and they will try to find assets for it. Those can be gold or any other form of real cash flow linked assets. And those assets have been steadily appreciating against the dollar. And that does make sense to me.
Got it. And you've also got this view on sort of structural disinflation. And so could you talk a little bit more about that? And could you talk a little bit about what could actually cause straight up structural deflation? And in that sort of scenario, how would different currencies actually play out relative to each other? So in that sort of scenario, what would you actually be bullish on? And which ones would you be bearish on? And since currencies is a relative game, you don't play the euro from an absolute standpoint. It's usually against different currencies. So how would you go thinking about that?
Well, that's a very good question. So the current system is built on credit expansion, and it needs inflation to function properly. Because if you use credit, which is debt effectively, and you want to use that to overlay cyclical growth on poor structural growth and kick the can down the road, you also need some sort of inflation to inflate away your debt burden.
Yep.
If there is deflation instead, your debt burdens, which are massive compared to your cash flow generating abilities, which can be GDP or can be cash flows for the private sector, are not going to be able to keep you out of a snowball effect. So your debt in real terms will keep on increasing if deflation is there. And that will just generate a disaster because you're not able to service your debt payments anymore. And again, if you're the government and people trust your currency, you're a currency issuer and you can try to keep alive. But if you're the private sector, you can't issue the currency. So if you're an over-leveraged corporate and you're in a deflationary environment, then you're bust. It's pretty simple. So if I think of deflation or deflationary forces and outright deflation rather than disinflation, which is just a lower year-on-year print of inflation, still positive, but trending slowly down. Deflation is outright negative year-on-year prints.
Yep.
In the CPI basket, basically. If I think of the latter case, then currency-wise, I'd rather own the dollar than anything else. And that might sound very strange, but the reason why I would do that is because you will be facing the cliff and the restructuring of some sorts of the current monetary system. And when that happens, a crisis has to take place first. So when a crisis takes place, then the dollar gets almost immediately bid straight away. And the reason is pretty simple. There is one entity, or let's say there are few entities that are able to generate dollar credit when it's needed. One is the US government, who can reach US jurisdiction very quickly. The other one are banks, and the euro-dollar system allows also foreign banks to lend dollars.
Yep.
But guess what? Foreign banks don't want to lend when a crisis comes, so they close the tap, and you're only left with the government to provide credit to the US jurisdiction, so dollars to the US jurisdiction, but not to the foreign people that actually need the dollars the most, because they need to service 12 trillion dollar-denominated debt, which are outside the US, issued by banks, corporations, emerging markets that have no direct access to dollar credit and not immediately to dollar liquidity either, unless the Fed puts up swap lines, but it's not an immediate reaction. So the first reaction you have is trade flows are stopping, cash flows in dollars are stopping, I am over leveraged in a currency that I have no immediate access to, so I'm going to scramble to get my hands on as many dollars as I can, and dollar is going to get bid. So if I'm facing deflationary environment, I'd rather own dollars than anything else, but not because I strongly believe in it, but it's because the architecture of our system will push flows towards the dollar in that case.
Got it. And one thing that you did say is, if we have a restructuring of the monetary system, one thing that has to happen is we're supposed to have some sort of a financial crisis right before that. And as we've seen, over the last few declines in prices, you see the dollar just absolutely spike. So one thing that I will follow that up with is, would you want to own number one? Would you? Well, actually, not number one. Just one question. So, would you want to own safe haven currencies? So, one is the Swiss franc, the other is the yen. especially against, what you would consider risk currencies. So, AUD, New Zealand dollar, other carry currencies, and so on. So would you take that sort of position where you go short AUD, long JPY, or short AUD, long CHF, or basically an anti-carry trade?
Yeah, exactly. You said it right straight away. Words directly from my mouth. You pulled them. Effectively, that will work mostly because the opposite trade, so long Australian dollar short any cheap funding currency like I don't know Swiss franc or yen, it tends to be the most crowded trade when volatility is very low and people are looking for carry, right? I mean, so they're going to borrow in yen at 0%, and they're going to buy Aussie dollars yielding 3 or 4%, and then they're going to hope nothing happens, and then the carry is effectively going to make their day, right? Those trades end up being very crowded, so the unwinding effect is actually going to, push the flows the other way, right? So all the yen that are invested abroad are going to be called back because people don't want, just want the safety of being invested in your domestic currency. And the other reason is, again, real interest rate differentials. So imagine you're Japan now, and the deflationary wave hits the world, or you're Switzerland by this sake. Switzerland is even a better example. So let's talk Swiss franc. And you have overnight deposit rate in Switzerland, which is negative 75 basis points or so, something like that, if I'm not mistaken. So extremely deeply negative nominal yields. So if you want to stem inflows in Swiss franc, you're gonna have to lower real interest rates so people stay away from your currency, because otherwise you're gonna devalue the purchasing power, right? How are you gonna do that? You have nominal interest rate already at negative 0.75%, and you have deflation on top. So how are you going to push interest rates into negative territory? Actually, there is a good chance that people might achieve a positive real interest rates because the nominal is negative 0.75, and maybe deflation in Switzerland pushes to minus 1%. So by owning Swiss franc, people are going to increase their purchasing power by 0.25% a year, right? So now ask yourself, how can Australia reduce their real interest rate? Well, they start from a theoretically steeper yield curve, and therefore they can start buying long end bonds, and they can push long end real interest rates lower because they have some room to do so. Switzerland has no room to do so. And so real yields are going to push flows towards yen and Swiss franc. The unwinding of carry trade is going to do the rest. So yes, I'd rather be long those than high yielding currency if you expect a deflationary shock, which, by the way, I do not expect. I'm in a disinflationary camp, and I do expect US inflation to print around 2% between now and year end. So for a few more quarters actually to come, even first quarter of next year, we might see inflation at about 2.5%, 3%. So another thing that I learned is that in macro world, you don't have to be attached to your ideas. You'll have to be flexible. You have to look at facts. And the fact is that the impulse of aggregate demand has been massive over the last year, and is obviously coupled with supply bottlenecks generates inflation for a few quarters. What I'm trying to say is that the structural forces are prevailing. The bond market has already smelled that there is no regime change. The reflationary trades are already rolling off. And I can see why that is, because there is no regime change long term.
Yep. And so when you actually think about global macro, and one thing that you said is you always have to be flexible. So when you think about global macro strategy, what are the most important leading indicators for you, especially when trading bonds, and to an extent when trading currencies as well? So one thing, of course, is your favorite is the credited pulse, but what else do you focus on? What else do you use?
So I was about to say my top three macro indicators are credit impulse. No, I'm just kidding. No, I mean, credit impulse is very important. The other indicator I would look at is the relative monetary policy stance. So I would look at, for example, spot real interest rates and term structure real interest rates. So across the curve as well, what's basically priced in by the fixed income market against an estimate of the natural real interest rate. So that tells you if on a structural basis you are accommodative or tight, and what is the direction of travel, right? So those two the credit impulse and the relative monetary policy stance in real terms are the one that I use for my macro compass. So I'll have to say those are the top two. And yeah, of course, there is positioning, which is extremely important, but that is more of a third dimension, basically, to the global macro investment approach, which has a lot to do with risk management, which has a lot to do with being nimble and humble, which means you might think that you are in one of my four quadrants, quadrant 1, 2, 3, and 4, and you have positioned accordingly, but your position should always assume you're wrong. Yes, because you will be wrong. So as an investor, especially if you're tactical, you will find out that unless you have very niche strategies, you will be wrong about 50% of the times. And if you're not, then I invite you to check again, because you're probably lying to yourself and hiding some trades. I am wrong about 45% of the times, approximately, maybe 46, 48, depending on the years. So the idea in global macro investing is that you have a global macro thesis, but if you're wrong and the facts are changing, you have to stop out. That's the third dimension, effectively. Third dimension is risk management. And that is probably the most difficult, because you can create a model for credit impulse and a model for R star and what have you. But the model for risk management and stopping out of trade ideas is effectively modeling your ego. And that is very complicated. Admitting you're wrong is one of the features of the best hedge fund managers out there. If you read Steve Drobny's books, which I found amazing, where he interviews hedge fund people, those people are extremely humble and they have no problem telling you what their worst trade is. If you ask them, they remember exactly where they lost money, what their risk management was, and if they messed up their risk management strategy, they will beat themselves up for so long, man. So that makes a difference.
So you mentioned that the best traders will always know, what their worst trade has been, and will stay humble about it. So, what is your worst trade ever?
That's a good question. So,
and if you don't want to share it, no worries.
No, that's fine. I mean, I'm speaking on behalf of myself anyway, so okay. I'm going to talk about my private account trades and not what my employer hires me for to manage on their behalf. So I'm going to say that these will probably be Bitcoin. So, okay, so I'm now going through the Bitcoin hole. So please allow me that. So Bitcoin is a very interesting asset, I think. It's a digital asset and it's not a currency. It has nothing to do with the currency, in my opinion. So I was trying to learn about this new digital asset about a year ago. So I started trying to understand how the thing actually works, which I think is pretty complicated if you want to really understand how it works. And I was simply asking myself open questions. And one of that was, can there be a Bitcoin standard, which was one of the things Michael Saylor brought forward. So I was just asking myself, with an open mind, can there be such a thing? I was looking into it, and at some point I came to the conclusion that if you are in, well, the conclusion was even yes at some point, but it's the risk management that was terrible around the trade. And let me explain why. So what I did is I look at my quadrants, and I said, okay, if it's a secular quadrant 1, where credit creation is very low and it decelerates because there is no credit appetite from the private sector, and the monetary policy is relatively easy, then real interest rates will be negative, and you have to look for a way to preserve your purchasing power for a hard asset. So maybe this digital asset can have a space in my portfolio, right? What I did is, what I normally do is I look at how volatile this asset is. So I size my position according to what the tail risk move against me could be in that asset. So I make some assumptions, I look at historical volatility, and then I make some macro assumptions behind, and I say, okay, I'm going to allocate X of my portfolio into Bitcoin, and this X is sized as if I effectively can take a drawdown this big, and if I take a drawdown this big, I'm going to stop out, and I'm going to move to the next trade, and my ego is not going to be touched by it. I'm just going to treat it as any other trade. Okay, so that's it. And what I did is I didn't do that. I didn't size it accordingly. I sized it way too big, which, by the way, was about 5% of my portfolio back then. So I was like, okay, I really liked it at some point. I liked the narrative, and it actually pushes you towards this sort of trades. And I sized it probably 3 times as big as I should have.
Mm-hmm.
Then I went in there, and at some point I was up by a zillion percent. Can't even remember how much it was. And then the volatility kicked in, and this stuff started printing 10% daily vol on a 5% allocation of my savings. That was a pretty decent chunk, or much more than I could stomach actually, on an asset that I'd studied upon, but it simply moved too much. And then at some point I had a further drawdown, and I simply decided to stop out from the trade because, it was just too volatile and the size was completely wrong. So my risk management and my sizing was horrible. And I will always remember that because I was, how can I say, very emotionally carried in the trade. There was a lot of narrative around it. It fit, from some feature of perspective, my macro thinking, but where is the risk management? So that's the third layer of, it can be credit impulse, it can be the relative monetary policy stance, but risk management and position sizing and being nimble and being humble, that is the third and the probably most important key of your global macro asset allocation.
Got it. And at ING, you manage about $20 billion or so, right? Which is a lot of money to someone who's just 17, and it's probably a lot of money to pretty much anyone. So what I wanted to ask you is, so do you have any tips for portfolio managers and people who manage outside capital, just from your experience?
Well, the hint I'm going to give them is, it doesn't matter what the size of your portfolio is. By the way, I concur with you, 20 billion is a lot also for a 30 years old guy like me, relatively young, and it still feels a lot. But as long as you have a process in place and a solid risk management system that you will adhere to religiously, then the size, of course, it's relevant, but it will give you ease of mind and peace of mind in the management of your asset allocation, because you will undoubtedly be wrong. You will. There is no way around it. And anybody who claims is always right, and if you look on Twitter, there are a lot of there is no track record, so you can just delete tweets that were wrong or hide poor calls. And if you follow me or you read my Substack newsletter, it's going to be exactly the opposite. I'm super transparent about being wrong, and any investor should, because this is a very humbling game, trying to have a decent asset allocation over the medium term. So if you are in this game, the best advice I can give you is work out your risk management strategy, work out your pain threshold, work out your style, because everybody has a different trading style and a different appetite for different strategies. Make sure you have your risk management ironed out first, and then we can talk about all the rest. And the other hint I will give career-wise for listeners here is to be curious and eager. If you treat finance and markets as a job, I don't know any successful guy that treats this as a job. If you know what I want to say. I know successful guys that are very passionate about this, or are very curious at least about this. And if you have somebody smarter than you who wants to be your mentor, just follow the guy and try to get as much knowledge as you can from these people. Those are very important.
Yep, got it. Well, Alf, thank you so much for being on the podcast. It was awesome having you. I'm gonna have to re-listen to the interview so that I can actually fully grasp what you said. You gave a lot of awesome information. So thank you for being on.
That's been an absolute pleasure. A fantastic podcast. You are a great host. Extremely young. I think at your age, I knew probably a tenth of the things you already know. So keep it up.
Thank you.
And for listeners who want to follow me, it's all free material. You can go on my Substack. It's called The Macro Compass. So you can follow me on Twitter @MacroAlf. Thanks again for the chance to be on the podcast.